Think of it this way. We come out of the Great Depression. We put tough new banking regulations in place. It works for about 50 years. We build a strong middle class. Starting in the 80s, starting with the Reagan administration, deregulation becomes the watchword of the day.
Right.
And there's less and less
but it
oversight.
Continued through the Clinton administration.
It continues through the Clinton
right.
years. It continues.
Bush,
it continues.
And then Obama.
And then what happens is they have now sold, the large banks, enough toxic mortgages to bring down literally millions of families, and they packaged them and sold them out into the economy, into pension funds and all kinds of other places.
You make an interesting
to
point.
Bring it all down.
You make an interesting point, because we thought of the crisis as about shaking the financial system to its core. It was shaking lives to its core.
Oh, that's the reminder. You know, all the way through this book, I talk about the big banks. I talk about after the crisis, how it was that they fought back against the regulation. Do you know at one point, they were spending more than $1 million a day in order to lobby against financial regulation. And this was after the American people had already bailed them out. But what was at the core of this, and what I talk about in here, were the families who just got slammed. You know,
easy credit and then could afford it.
It was worse than easy credit. There's a woman in here. Remember, I was doing studies all the way through this, serious empirical studies, had good co-authors at other universities around the country. And there's one person in particular I talk about in this, an older woman who was in one of our studies in 2007. And she had called the office. She'd been in the study, been picked up because she had filed for bankruptcy. And she explained her story about how she and her husband had moved to this little town in the South. He had passed on now, but she was getting along okay. She could manage on her Social Security. Then the nice man from the bank called and told her he could lower her payments. And at least the way she understood it, she said to him, "But what if the interest rates go up later on?" And he said, "I'm a banker. I will know these things, and we'll put you back in your old mortgage." And then she said, he never called. And so the payments shot up. They were bigger than her Social Security check. She tried borrowing, holding it together. But here was the part, Charlie. She called because everyone who participated in the study, who did a long questionnaire, we offered them $50. They would get a check, and the check had to be mailed after it was processed sometime down the line. She called us to say she was going to be moved out of her home in a few more days, and she would be living in her car, and she wanted to know how she was going to get her check. That's what the economic crisis of 2008 meant. It was people like this retired woman who lost her house and, at least for a while, ended up in her car because some banker made quota by calling her and selling her an exploding mortgage.
I totally agree. I mean, and not only that, I mean, I know people who ran small businesses.
I talk about this in the book, and I talk about small business lending because you know what really gets me about that story? That was happening when the United States taxpayers were shoveling money into these huge financial institutions to stabilize them. And here was the big mistake, doing it on a no-strings-attached basis. So the money came in from the taxpayers, and the big financial institutions, we were told, would turn around and lend it to the small businesses, would turn around and help people like the homeowners who were in trouble. Instead, they held on to it. You know what some of them did with the money? They bought other banks. They expanded their reach rather than using that money to help heal the American economy. Today, those big financial institutions that we were told in 2008 were too big to fail, today they're 38% bigger than they were back then.
Clearly that's what happened because of all the things that we talked about during those years, and especially in 2008, and what had happened in derivatives and all the other kinds of things happened. But then you had, first under the Bush administration, Paulson, Bernanke, Geithner. Then later you had under the Obama administration, a different Treasury Secretary, Geithner, same Fed Chairman, Bernanke, and I've forgotten who was at the New York Fed at that time. They get a lot of credit for saving the economic system. Do you agree with that?
You know,
that what they did in the emergency situation, they made hard choices that had to be made. My question, do you agree with that assessment of what those people did in those two administrations?
Look, as I make clear, when there was only so much time and so much money to go around, they saved the largest financial institutions. They did not focus on American families and small businesses.
So we're now talking about not the banks who made the loans. We're now talking about what happened when you had a financial disaster that affected everything.
Yep.
What should they have done?
They should have put that money into the banks with strings attached. Let me put it this way. Whenever a big corporation gets into financial trouble outside this crisis, when a big financial corporation gets into trouble and new money comes along to be put in, whether the company ends up going through Chapter 11 or not, the new money always says there have to be changes here. What kind of changes? You wipe out the old shareholders. You make the old debt take a haircut. You change the management, and you make sure they've got a new and different business plan. Why? Because it disciplines that company to run a different kind of organization, and it's a signal to everybody else. It says, listen, CEOs, if you run your business so that you're going to need outside money, then it's going to be your job that's going to be on the chopping block. That didn't happen in the bailout in 2008. Basically, Henry Paulson, followed by Tim Geithner, said, take our money, please.
Have you never met a banker you liked?
I've met lots of bankers I like.
I mean, do you think everybody on Wall Street is part of the problem?
Look,
I mean, because that's one of the things they'll say to me. They say, I hear all this time, I mean, there's a lot of things that we're trying to do. Yes, we're trying to make a profit, but it is not as brutish as Elizabeth Warren would make us.
Well, all I can say is they continue to fight the regulations. They continue to fight to create as many loopholes as they can in everything that
But
gets
that happens
written.
in every industry, doesn't it?
And that doesn't make
across
it
the
better,
board. No, it
Charlie.
doesn't. No, of course it didn't. But I'm just saying the money that talks for financial institutions also talks for automobile companies. It talks for a whole range of other companies, pharmaceuticals,
But that goes
oil.
absolutely. That goes back to the
because it's
heart.
money talks in politics and in Washington.
That's
Because
the
they have to
heart,
get elected.
That's the heart of why I wrote A Fighting Chance, because we now have in Washington concentrated money, concentrated power, making its voice heard day after day after day on issue after issue after issue. And you're exactly right. It's not just in banking. That's where I experienced it up close and personal and talk about it. But it happens across a range of industries. And ordinary families, regular families, hardworking people across this country are playing on a playing field that is increasingly tilted against them.
Tell me.